Most of us see the tax code as this giant, complicated rule book we just have to follow. But what if I told you it's actually a playbook, a system of incentives? Well, in this explainer, we're going to deconstruct how the tax system is really designed to be navigated strategically, not just obeyed. So let's start with this one question. Is the tax system a set of rules or a system of incentives? Today, we're looking at it as a roadmap of things the government actually wants us to do. And believe me, that one shift in perspective, well, it changes absolutely everything. You see, the tax code is not a one-size-fits-all deal. Nope. It operates in two completely different ways depending on where your money comes from. It basically creates two separate financial worlds. And the biggest difference between these two worlds? It all comes down to one little word: sequence. If you're an employee, the path is simple. You earn, you immediately pay taxes, and then you get to spend what's left. But for business owners and investors, that path is totally flipped. They earn, then they spend, or reinvest, on all sorts of deductible expenses, and then they pay taxes on whatever's left over. That simple change in order makes all the difference in the world. Okay, so how do you make that jump? Let's dive into it. We're going to break down the three core mechanisms, the three main levers, really, that let you make that powerful shift from being taxed first to being taxed last. So lever number one is the business framework itself. Just by operating inside a formal business entity, you suddenly unlock a whole world of powerful tax deductions that are completely off limits to a regular employee. And the key to this is something called a pass-through entity. Think of an LLC or an S-Corp. This structure is so critical because it lets the profits from the business flow directly to the owner's personal tax return. It completely bypasses any taxes at the business level. This is the secret to avoiding that painful sting of double taxation. So what's the game plan? Well, experts often suggest starting out with an LLC. It's simple and it gives you liability protection. Then, once your profits hit a certain point, say around $50,000, you can make a choice to be taxed as an S-Corp. And why would you do that? The main reason is to strategically slash that really burdensome 15.3% self-employment tax. All right, on to the second lever. This one taps into an area the tax code absolutely loves to incentivize: real estate. Seriously, the government wants private investors to get into housing, and the tax code is their number one tool for making that happen. The main engine here is this really powerful idea called depreciation. Okay, so it's a non-cash deduction, which means no actual money leaves your wallet. It just lets you write off the value of a building over time. This creates what's known as a paper loss, and you can use this loss to cancel out real taxable income, even while your property is likely going up in value. It's pretty amazing. But get this, you can put this deduction on steroids. There's a strategy called a cost segregation study that lets you accelerate your depreciation. Just look at the insane difference on this chart. For a $500,000 building, normal depreciation might get you an $18,000 write-off. But with acceleration, that skyrockets to a $120,000 write-off in year one. It's how you max out your paper loss right away. So this leads to the million-dollar question, right? How in the world can these massive paper losses from a real estate deal actually lower the tax you pay on your main income, like from your 9-to-5 job? Well, there's a very specific loophole in the tax code that gives us the answer: short-term rentals. If the average person stays at your property for 7 days or less, and this is key, you can prove you materially participate, meaning you're actively managing the property, you're not just a passive owner, then bingo. Those huge paper losses can directly wipe out taxable income from your main job. It's an incredibly powerful bridge between those two worlds we talked about. And that brings us to lever number 3. Now, this is a more advanced strategy, the kind you hear about the super wealthy using, and it basically separates the act of getting cash from the act of paying taxes on it. Let's just walk through a quick example. Picture an investor who has a capital asset, maybe a stock portfolio, that's grown to be worth a cool $10 million. Now, if they wanted to get their hands on some cash by selling that portfolio, they'd instantly trigger a massive capital gains tax bill. We're talking something like $2 million, just poof, gone. But here's the strategic play. You don't sell, you borrow. That investor can go to a bank, use their $10 million portfolio as collateral, and walk out with a loan for, let's say, $5 million. And this right here is the magic moment. Loan money is not considered income by the IRS. So that $5 million cash infusion, it's 100% completely, totally tax-free. They get cash to live on, their original asset keeps growing, and they haven't paid a single penny in taxes. So you can keep this strategy of borrowing against your assets going for a whole lifetime. But what happens at the end of the line? Well, that brings us to the final piece of the puzzle, how all of this allows wealth to be passed down through generations, all very tax efficiently. The final critical piece of this whole strategic puzzle is a provision in the tax code called the step-up in basis. This is the mechanism that really completes the entire circle. So check out how this works. Let's say an asset was bought way back when for $100,000, and over the owner's lifetime, it grew to $10 million. When the owner passes away and their heir inherits it, the cost basis isn't that original 100 grand. Nope, it steps up to the current market value, $10 million. And just like that, decades of capital gains are legally and permanently wiped off the books. Gone. Now think back to that $5 million loan we talked about. The heir can just sell $5 million worth of that newly inherited asset to pay back the bank. And because their new cost basis is $10 million, selling a piece of it for $5 million means they have zero capital gain. The cycle is complete. The family got to enjoy tax-free cash for years, and the underlying tax bill was eventually just eliminated. So the biggest takeaway here is that understanding how business structures, real estate incentives, and strategic debt all work together, well, it can totally transform your relationship with taxes. It really is the difference between just passively complying and actively strategizing. The tax code isn't just a rule book. It's a map full of incentives. The only question left is, where does your strategy need to evolve?